What if losing 10, 20, even 30% on an investment could still leave you better off than simply paying your taxes? I'll show you how a $100,000 tax bill can become an investment where you're effectively risking only about $30,000. This isn't a loophole. It's actually written into Canadian tax law, and these are called flow-through shares. Flow-through shares come from companies in mining, oil and gas, as well as renewable energy. Let's focus on mining, because that is the biggest segment. Here's the whole idea in plain terms. Imagine a mining company that has tax deductions it cannot use because it isn't profitable yet. The government lets that company transfer those deductions to you. You provide the capital that funds the exploration, and you get the tax write-off. That's the whole engine. And it's the government's way of making sure that these startups get funded, using your tax bill as the incentive. The benefit shows up the moment you invest, not when the company strikes gold. Let's look at an example. Let's take a dentist, Sarah. She had a great year. She's staring at a $100,000 tax bill. Option 1. Simple. She pays the CRA $100,000. Gone. Zero risk, zero upside. Option 2. She invests that $100,000 into flow-through shares. For many top bracket taxpayers like Sarah, the combined deduction and credits can reduce the effective after-tax cost to roughly 30 cents on the dollar, meaning $100,000 leaves her effectively risking only about $30,000 in the market. The exact figure depends on your province and the bracket, so treat 30% as a ballpark. It's not a guarantee. And here's the kicker. Even if Sarah sold that investment about a year from now for 60 cents on the dollar, she'd still be ahead of where she'd be if she'd simply paid her taxes. There's a supercharged version for critical minerals, lithium, for example, copper, nickel, and the list in Ottawa keeps expanding. They even added phosphate in early 2026. There's a critical mineral exploration tax credit, a 30% federal tax credit, double the standard 15%. Both run through March 31st, 2027. This is what people used to call super flow through, and right now, it's the headline. The government spots you a massive head start, and the critical minerals version makes it even bigger. It's not risk-free, but it is risk discounted. But knowing the math is useless if you get in the wrong way. 2 ways in: a direct placement, where you buy into one company, all your money in one name, usually locked for 4 months, and generally need to be accredited investor for. Or you go through a limited partnership. It spreads your money across many miners at once. So you're not betting on a single company, but your money is typically locked up for 12 to 18 months. So the real choice isn't the tax savings. Both structures provide that. The choice is concentration risk versus liquidity. Remember, these junior miners aren't profitable. They're in exploration. But the right one can hit a real discovery. And that's where the upside lives. A capital gain on top of the tax savings. Now, before you think that this is free money, there's one 2026 catch almost nobody mentions until your accountant calls. Recent alternative minimum tax changes mean that big flow-through deductions can trigger AMT in the year you invest. And the proposed fixed was confirmed dead in budget 2025. It doesn't kill the strategy, but it means the savings can play out differently depending on your full tax picture. This is exactly the kind of thing you don't want to model on a napkin. So here's the whole thing in one breath. Flow-through shares let junior miners hand you their tax deductions in exchange for funding Canadian exploration. For a high earner, that could cut your effective after-tax costs to roughly 30 cents on the dollar. And with 30% critical mineral credits running through 2027, you could potentially move it even lower. You can lose 10, 20, even 30% on the actual investment and still manage to come out ahead of simply paying the CRA. It's a serious head start. This isn't for everyone. There's a real risk. It's built for someone who's maxed their RSP room. The 2026 limit is $33,810 and earns in the top tax bracket, which this year kicks in at $258,482. That's who this is designed to help. If you want this mapped against your actual income, your RSP room, AMT exposure, and the right province for the credit, that's a 20-minute conversation, and it's not a guess. The link to book a free strategy call is in the description. Thanks for watching.